All right, let's see what we can do with this group work for chapters 10 and 11. This first problem, we're talking about Brigham Company. They're issuing bonds with a par value of $800,000. Remember, that's kind of the face value of the bond. That means that's the amount they're going to have to pay back. The bonds are going to mature in 10 years, and they pay 6% annual interest in semi-annual payments. On the issue date, annual market rate for the bonds is 8%. All right, so our bond rate is 6%, and the market rate is 8%. So are we selling this at a discount, or are we selling it at a premium? And hopefully you're thinking it's going to be a discount. Went ahead and pulled a calculator up there just in case we end up needing it. All right, so several questions. What is the amount of the semi-annual interest? How many interest payments? Use the interest rates given to select whether the bonds are issued at par or at a discount or premium. Compute the price. Prepare a journal entry. Okay. So this first one, requirement 1 through 3, what is the amount of each semi-annual interest payment for the bonds? How many payments? Use interest rates given. So they're kind of giving us a formula to figure this out. So what's the par value at maturity? 800,000, right? And then what's the operator going to be? Well, normally it's going to be a multiplier, right? We're going to multiply it by some semi-annual rate. Well, what is the stated rate on our bond? It's 6%. Semi-annually, what would that be? This is an annual percentage rate, so the semi-annual rate is going to be 3%. And that means that my semi-annual cash interest payment is going to be $24,000. Every 6 months, we're going to pay $24,000. Then it asks for the number of payments. Okay, well, how many years is this bond? Right? How many years is this bond going to be? It's 10 years, right? And how many times are we going to pay? We're going to pay semi-annually, right? So 10 years, if I pay twice a year, that's going to be 20 payments. And then the question becomes, are the bonds going to be issued at par, at a discount, or at a premium? If my bond rate is less than the market rate, then we're going to be selling at a discount. Hopefully you're thinking discount. All right, in requirement 4, it's the same data, but now we're looking to compute the price of the bonds as of their issue date. So how much is this selling for? And notice that we know we're selling at a discount, but we don't know what we're selling for. So it says table values are based on N and I. Well, do you remember what N is? N is the number of payment periods. That's what that formula is. Remember, it's 10 years semi-annually, so N is 20. Well, what's the interest rate that we're going to base our price on? The interest rate that you base the price on for present value factors is always going to be the applicable market rate. Well, the market rate is 8%, but at a semi-annual payment, that rate is 4% because it's half, right? If we were saying 10 periods here, we'd definitely be doing 8, but we're doing 20 periods, so it's going to be 4%. So now what has to happen is we need to find the table value because we've got to look at our cash flows. So it's saying, how are you going to define the present value for the par and maturity? That's that lump sum, right? Well, let's go ahead and just get the multiplier. I know that I'm going to multiply some factor by the 800,000 lump sum. And then for the interest, which are the semi-annual interest payments, I'm going to multiply some value by one interest payment, which is 24,000. Now what it comes down to is trying to find the right table value. I've got to look for 20 periods at 4% for the present value of $1. So we've got to find the right table for that. I'm going to go on over to table B1. This is the present value of $1. And if I find 20 and I go across then to 4%, there's 1, 2, 3, 4. I get a factor of 0.4564. 0.4564. So I'm going to plug that one in there. 0.4564. And that tells me that the present value of that 800,000 right now is 365,120. It seems kind of low, doesn't it? Well, it's because it's 10 years. 10 years down the road. How about that interest? Well, I'm going to roll on over, I think it's table B3 for the present value of an annuity. Present value of an annuity of $1. That's what I need. 20 periods, 1%, 2%, 3%, 4% shows me 13.5903. So I go to 13.5903, and it tells me that the present value of my interest payments are $326,167. Therefore, I should be selling my bond at $691,287. Okay, not so bad. The hard part's just knowing what table do I need to go to, right? To figure that one out. The lump sum is the present value of $1. The interest payments are the present value of $1 of an annuity. All right, let's go to requirement 5. All right, so this one is asking us to record the issuance of the bonds, right? Record the issue of the bonds with a par value of $800,000 for cash. Remember, we did this on the discount. First off, how much cash did we get? Well, I think I probably need to go back and look. Let's make sure we know. This is how much we're selling the bond for. It's $691,287. So I'm going to get cash of $691,287. I'm going to skip a line because I know I got to do that discount or premium, but how much am I going to owe on the bond at the end? $800,000. That's how much, right? I owe $800,000. Obviously, I'm selling this thing at a discount, right? So I need another debit, and that discount is just calculated as the difference, $800,000 minus $691,287. So we're going to have a $108,713 discount. All right, that just about gets us up on that bond. Let's go on over and see what else we got. We're done with all our requirements on this problem. So we hit next. And we've got a whole new problem. This is January 1. Eagle borrows $100,000 cash by signing a 4-year 7% installment note. Note requires 4 equal payments of $29,523 consisting of accrued interest and principal on December 31 of each year from 2017 through 2020. This is an installment note. We're making the same payment every single time, right? We're going to make that same payment, but it's going to be a portion of principal and interest. So how do you think we're going to get this one going? Well, let's just go ahead and start it with the beginning balance. That's easy. And now we've got to find out how much interest expense are we paying on this very first payment? Well, it's 7%. 7% of what? It's 7% of the beginning balance. Well, that's just going to be $7,000, right? How much is our cash payment going to be? Let's go ahead and put that in. Matter of fact, how much is it all the time? It's $29,523. It doesn't change. I'm just going to go ahead and fill that in. That's how much we're paying every single time on this note, just like a mortgage or a car payment, right? They gave us that. We could have figured it out. We could have done it. Okay. So how much are we going to reduce the balance by? If $7,000 of this $29,523 goes to interest, how much goes to principal? Well, $29,523 minus $7,000 gives us $22,523 to notes. So what's the ending balance now of our principal? It's $100,000 minus $22,523, or $77,477. So if $77,477 is our ending balance, what's our beginning balance? Well, it's the same thing, right? We go from one ending to the beginning of the next, 77,477, and now we have to calculate our interest again. Again, it's 7%, so 7% of what? Of 77,477 times 0.07, and we get an interest now of 5,423. We're going to round it. It tells us there, the letters in red, to round to the nearest whole. So 5,423. Well, I have to take 5,423 away from the 29,523 payment. 5,423 says that we must be paying down principal of 24,100. Okay, what's our new ending balance? New ending balance is 77477 minus the 24100 says that we now have an ending balance of 53377. That obviously is now our beginning balance. We have to calculate that now with interest times 0.07. Gives us an interest factor of 3736. So how much principal are we talking about now? If we're talking 29,523 minus the 3736, we have a 25,787, can't type, 25,787 principal reduction. So now 53377 minus 25,787 says that we should have a balance of 27,590. If that becomes the beginning, and we take out the interest minus the note, there's the, you see what happens, right? They've probably plugged this in because of rounding anyway, but you'll see that it comes out to be an ending balance of 0. It's not a miracle that this is the payment. It's very scientific. It's just reverse engineered for the compounding to figure out how much interest should be applied in each period. We use the tables actually to find that payment amount. All right, let's go on over to number 3, see what we've got here. So we're looking at some common stock. So now we've moved over to the next chapter. We're talking about the equity stuff, and we're dealing with Alexander Corporation reporting some components of stockholders' equity. We can see there's common stock, there's some paid-in capital, there's some retained earnings, and then we had a bunch of transactions, and guess what they want us to do? A ton of journal entries. So the first thing they want us to deal with is purchasing 3,000 of our own common stock off the open market at $25 cash per share. Do you remember what that's called? It's kind of that weird thing, right? Here's what we're dealing with. We've purchased our own stock off of the open market, and we call that treasury stock. So we're going to debit our treasury stock common, and if we do the math there, it says it was 3,000 at 25. So that's a $75,000 stock purchase, and that comes out of cash. Remember, treasury stock is not an asset. It is a negative equity account. We cannot buy our own stock and call it an asset. It doesn't work that way because it really is of no value to us when you think of it that way. So it really is a negative equity type account. And remember, we've got to keep track of what we bought, 3,000 shares at 25, because when we sell it, we've got to make sure we're taking it off at that same level. So here we now record the declaration of a cash dividend of $1.50 per share. Cash dividend of $1.50 per share. So what we have to do is we got to multiply that $1.50 by how many shares we have outstanding. Well, this says that we have 30,000 shares issued and outstanding. And before you go calculate 30,000 times 150 and check my work tells you it's wrong, right? You have to consider the fact that you've already taken 3,000 shares off the market. You're not going to pay yourself for those shares. So really, when we calculate the dividend, it's based on 27,000 shares, the 30,000 shares minus the 3,000 that we bought back. Multiply that by $1.50, and my dividend declaration should be for 40,500. Do you remember how we record the declaration of a dividend? Where do dividends come from? They come directly out of retained earnings, 40,500. Because remember, retained earnings is where we accumulate our net income year over year over year over year, and a dividend is simply a distribution of net income back out to the stockholders. Okay, are we paying it yet? No. The date of declaration is when we record our liability, saying that it's going to be paid. It's a common dividend payable as a liability. All right. Now we record the payment of the cash dividend declared on January 7th. Now we're actually going to pay it back out. Okay, it's February 28th. Well, if I've got to pay cash, I know cash is the credit, and I know how much the dividend was as well, right? This is just the reversal of the one we just did. All I'm doing is I'm now relieving that dividend payable. It's no longer on my books. I no longer owe it because I've paid cash out. All right, got to start thinking about the treasury stock again. Just as a reminder, we bought 3,000 shares at $25 a share, and now we're selling 1,200 of those 3,000 for $30. Okay, well, what do we get? We're getting cash, and we calculate that cash as 1,200 shares times $30. So I'm getting cash of 36,000. Okay, well, I know that the treasury stock has to come back off the books, right? What does it come off the books at? It comes off at what we paid for it, 1,200 shares times 25, right? So that's going to come off at $30,000. Well, I can't be done. I know I have to have a credit of 6,000, and the question is, where does it go? Anytime we have quote unquote excess capital for common stock, it goes into a paid in capital account, and in this case, it's going to be paid in capital for treasury stock. So that's where our 6,000 goes. And we have to keep track of what's in that account because we can never make that account go negative. It's got a $6,000 credit in it. It cannot have a debit balance. So if we've got to take money back out of it, we can only take 6,000 out. Okay, how many shares of stock do we have left? We just sold 1,200 of 3,000 shares. We've got 1,800 shares on the books still at $25 per share. All right. So now we're going to reissue another 1,500 shares of that treasury stock, but at $20 cash. Uh-oh. Sounds like we're in trouble. 1,500 times $20 per share says that we're actually going to get cash of $30,000. Okay, I'm going to go ahead and just skip a couple lines because I know we're going to need to. I'm going to take the treasury stock off the books, right? Remember what we paid for it? We paid 25 bucks, 1,500 times 25. So we paid 37,500 for that stock. That's how it has to come off the books. But we got cash of 30,000. The rules say first, take what you can out of that paid in capital treasury account. So I can take as much as possible out of that. Well, how much was in that paid in capital treasury stock? There was only 6,000 in it as a credit to begin with. I need more than 6,000, so I'm going to take it all, right? Now, no matter what, I know I need another 1,500, okay? What do the rules say? If I ended up depleting all of the paid-in capital treasury on the sale of treasury at a loss, basically, I have to eat the loss, and it's got to come directly out of my retained earnings. That's what the rules say, okay? A little bit tricky. Okay, I think I still have some shares left, as it would be. We'll see if anything has to happen with, right? Or have I now sold them all? I don't remember, right? How many do we have? There's 1,500 out. There's 1,200 out. So that's 2,700 out of the 3,000, right? All right, so now I get to record the declaration of a dividend at $2 per share. It's a declaration. You remember what happens? Right? I know it's going to be coming out of retained earnings, and I know that I have a common stock dividend payable. Well, how many shares of stock are out there? I have 300, I believe, now in my treasury stock. I had 30,000 on the books, minus the 300, gets me to 29,700 shares at $2 per share. So it looks like this dividend is going to be 59,400. Okay. Now I record the payment of that cash dividend. Just reverse engineered, right? So common dividend payable has to come off the books, and I get to pay it out in cash. That one's pretty easy. We like that one. Okay. And then finally, we get down to where it says record the transfer of the credit balance of $52,000 in the income summary account to the retained earnings account. Right here, we closed the $52,000 credit balance from net income in the income summary account to retained earnings. You remember what happens? At the end of the accounting cycle, which is December 31, we have to zero out all of our revenue accounts and zero out all of our expense accounts. And we do that by sending them over to an account called income summary, which is also temporary. What they're saying is that income summary has a credit balance of $52,000. And finally, what we do to close the books is we close income summary down to retained earnings. Well, if income summary had a credit balance, in order to get it to zero, I must debit it. So income summary is going to have a debit of $52,000. And where does it go? We accumulate all net income to retained earnings. All right, let's go just take a real quick look. Can we do a check my work on this one? Here it is. Let's just see what we got. It might not be complete because we haven't finished all requirements, but it looks like everything's in the green. All right, so we go on down to requirement number 2. And here we're looking at the same thing. It says to prepare a statement of retained earnings for the year ended December 31, 2017. Amounts to be deducted should be indicated by a minus sign. You may not remember this. It seems like it's been forever since we did it, but all we're doing in the statement of retained earnings is explaining the changes that should have happened before we close down net income. So we always start with our retained earnings at the end of last year. So retained earnings December 31, 2016. And do we know what it is? Sure enough, it's right here, right? $340,000. This is at December 31, 2016. Retained earnings was $340,000. Do you remember what things we have to do? We have to add in our net income, and then we have to take away our dividends. And just in case you didn't notice that, if you have any treasury stock issuance problems, we definitely had a treasury stock reissuance problem, didn't we? So what was net income? It was $52,000. We just closed it from income summary. How many cash dividends did we declare? Well, if we go back over to requirement number 1 and we look through all of the times that we declared a dividend, it adds up to $99,900. Okay, so this is minus $99,900. What are they talking about on this treasury stock reissuance? They're talking about the fact that we had to eat this $1,500, right? That's what they're looking for, is having to eat that $1,500. So we do minus $1,500 there, and that gives us our retained earnings at December 31, 2017. That's what retained earnings should be. Let's check my work. I'm hoping it doesn't error out. I saw an embedded error question. So still not complete because I still have to do required number 3, but everything is good here. Okay, let's return, and we'll move on over to requirement number 3. And finally, it says, fill out the stockholders' equity section of the balance sheet. Here's the thing. In the stockholders' equity section, stockholders are, I don't know, they're kind of crybabies. They have to be listed first. If you had preferred stock, you'd have to list the preferred stockholders first, then the common stockholders. But no matter what, your common stockholders want to be listed first because they think they're super important, and they are, because they've contributed a lot of money to our company, right? So common stock at $25 par value, I'm just going to go with it, right? What is it? I mean, how much do we actually have out there? Do you remember? It was $25 par value, and our gut is to take 30,000 times 25, right? And you'd be absolutely right. So that's 750,000, because there are really still 30,000 out there. We didn't change that. It's 750,000, right? And then we had some paid in capital in excess of par value. It's right here. It's still this number. We haven't changed those two accounts at all. The only paid in capital account that we changed was paid in capital treasury stock. So these two things are still exactly the same. Then we usually list our retained earnings. What has happened to retained earnings? Well, we just calculated it. It's in requirement 2. We don't have to go figure it out. We just did this. It's $290,600. But what about that 300 shares of treasury stock that we still have in our coffers, right? We're still holding on to 300 shares of our common stock as a negative equity account. And that has to be listed here. So it's going to be less the cost of treasury stock. Do you remember what we bought it for? 300, right? How much was it? I think it was 25 bucks. So $7,500 is a negative equity, and that leaves us with total stockholders' equity of $1,083,100. Let's check my work. And now we have finally that our answer is complete and correct, and that is going to finish up our group work.